In this video, I'm going to demonstrate a simple yet reliable mean reversion strategy, which has been working pretty well on pound-dollar forex pair. I'll show you the entry and the exit rules, but then I'm going to show you another 4 optional exit rules or exit strategies. I want to focus on one of those particular exit strategies, but I've included the others so we have a comparison. You could say that some of these exit rules are part of the stop loss strategy. And if you've done any work or any strategy development, especially on mean reversion strategies, you would have probably discovered what I've discovered, which is a lot of the time, or most of the time, stop losses generally degrade the performance of a mean reversion strategy. However, the type of stop loss or the type of exit strategy, which I'm going to focus on and show you today, actually improves the performance of this mean reversion strategy. And of course, if you like the idea, you're very welcome to steal it from me and use it for your own trading strategies. I didn't think up the idea myself. I actually read about it in the Unknown Market Wizards books by Jack Schwager. Off the top of my head, I can't actually remember which trader talked about it, but as soon as I heard him explain it, I thought I wanted to test this for myself. The Unknown Market Wizards, which I believe is the latest of the Wizards books, is definitely well worth a read. I highly recommend that one. Now, back to the strategy. For those of you who don't already know, mean reversion is when we're buying into extreme weakness or buying after a big down move and then exiting after a rally, exiting into strength. By using a normal stop loss, let's create a scenario. Let's say we're in a long trade, so we've seen the market have a bit of an extreme down move and we've entered the market, we've bought. Now, our stop loss is going to be below our entry. So if the price then moves against us too far, if it falls even more, then we're going to get out at our stop loss. But isn't that exactly our entry conditions? Our entry conditions are actually to buy when the market falls. So we're actually getting out of the market at a potential better entry to the market, if that makes sense. So it's no wonder that a stop loss of that kind doesn't work particularly well on mean reversion strategies. So maybe what I'm about to show you is the answer. So let me go and show you the entry and the exit rules, and then we'll talk about the different exits which we're going to test. Okay, the trade entries. I've already mentioned it's pound-dollar forex pair, and we're going to be looking at the daily chart. And by the way, I mentioned I was very quick to want to test out this exit method, and this is pretty much the first mean reversion strategy which I've tested the exit on. But as the results were a drastic improvement, that's why I wanted to share it with you as soon as possible. So to get in the trade, we want to see 4 red bars and then we go long on the next open. So looking at a candlestick chart, if we see 4 red daily candles, then we go long or we buy on the next open. And the opposite for short trades, 4 green bars, then we short the next bar on the open. Trade exits, this is what we want to talk about. Now, what do we want to test? Number 1, we want to test the stop and reverse. We've just seen the entries, so if we got 4 red bars, we go long, and then if we get 4 green bars, we go short. But if we're already in a long trade and we see 4 green bars, then we'll exit the long trade and then we'll go short. So that means we exit the original position and then we reverse the position, okay? So that's our stop and reverse. And the stop and reverse actually stays in for the remainder of these 4 exits. So we're always looking at stop and reverse exits. For example, if we're using a fixed 500 pip stop loss, but the position's going against us and we get an entry to go in the opposite direction, so that will be a stop and reverse exit. We take the stop and reverse exit before our stop loss gets hit, okay? If our stop loss gets hit first, obviously we're going to be out of the trade and then we'll be flat on the position. So exit number 2 is the fixed pip stop loss. We all know what they are, and we're going to run an optimization just to see whereabouts the best area is. Is it going to be 150 pips? Is it going to be 400 pips? We're going to find that out. And the object of this development is not to find the best fixed pip stop loss. It's just to find a pretty good one, a pretty stable one, so that we compare it to the one which I really want to talk about, which is exit number 3, which is the timed exit if showing a loss. So let me explain. The timed exit is going to be done in bars, or in this case it's going to be days because we're looking at a daily chart. So let's, for example, say a timed exit is 6 bars, but only if showing a loss. So if after 6 bars in the trade we're showing a loss, then we'll exit the trade. If after 6 bars in the trade we're showing a profit, we stay in the trade. We don't do anything. Okay, so it's only a timed exit if we're in a loss. Number 4 is exactly the same, timed exit if showing a loss, plus having a fixed pip stop loss as well. That means that we're going to know that before we get into the trade where our maximum loss is going to be, because we have that fixed pip stop loss. We might hit the fixed pip stop loss first, and then we won't be using the timed exit. And number 5 is the timed exit only. So that doesn't include if we're showing a loss. So it just says, let's say our timed exit is 6 bars. After 6 bars, we get out of the trade regardless of whether we're in profit or a loss. Okay, it's just a fixed timed exit. So exit number 3, the timed exit if showing a loss, is the one we want to focus on. And we've got the other 4 results in there just to make a comparison to it. The testing we're doing is using data from Oanda from January 2008 through to August the 24th, 2024. And we're testing just with a one fixed full lot, which is 100,000 units. And all the testing I'm doing in multi-charts, which is the testing and development trading software which I use. So here's the results, and I've just put them in this spreadsheet with focusing on 5 major results which I want to look at. Those results are the net profit, the maximum strategy drawdown across that backtest, the return on the max drawdown. This is quite an important one for me anyway. The average days in the trade, that's how long do we spend in the trade, how long a trade's open for, and the largest loser, that's the largest loss or any individual loss that we've seen. And I've made some highlighting there so we can look at to see which is the best and which is the worst. So let's go through them. First of all, we've got no stop loss, so that's just the stop and reverse exit. That's the only exit we've got, is the entry in the opposite direction. Okay. Then we've got a 500 pip fixed pip stop loss. Now I run an optimization and 500 pips was about the best one, and we'll see that later on. I run an optimization on the timed exit if showing a loss, and we found that 11 days was stable, is pretty good. Then we've got an 11-day hold if showing a loss plus the 500 pip stop loss as a kind of fail safe. And then we've got our timed exit, which is of 16 days. So we exit after 16 days, whether we're in profit or a loss. So looking at net profit, we can see that the one making the highest net profit is our timed exit if showing a loss. So exit after 10 days if we're showing a loss. If we're not showing a loss, we stay in the trade. The worst for net profit was the 16-day timed exit. Looking at the maximum strategy drawdown, the biggest drawdown was just the stop and reverse exit or no stop loss whatsoever at nearly 40,000. The least maximum strategy drawdown was our 11-day timed exit if showing a loss at 22,000. The best return on the maximum strategy drawdown is the 11-day hold if we're showing a loss at 5.47. And that, if you don't already know, that's just a calculation of the net profit divided by the maximum strategy drawdown. So in this case, we're looking at the 124,000 divided by the drawdown or the max drawdown, which was 22,000, and that's our 5.47. The worst there was the 16-day hold, followed closely by the no stop loss whatsoever. Now, average days in trade, this is an interesting one and something that a lot of you guys don't actually consider, but I think it's a huge consideration. The best equal results actually they're all the timed exits, aren't they? All at 15 days. The worst was using no stop loss or just a stop and reverse exit at 30 days. Now this is where I think about a trade in terms of efficiency. Actually, this is an idea that I got from Larry Williams, trade efficiency. If we look at the top result for the no stop loss, we got a net profit of 112,000, but the average days in trade are 30 days. But let's say using the 11-day hold if showing a loss, for argument's sake, let's say it also makes the same net profit, 112,000. It does actually make more, but it makes that with an average days in the trade of only 15. So it's half the time in the market as using the no stop loss. So as far as I'm concerned, that's twice as efficient. So that's a big consideration for me, especially when we're talking about Forex, because we have the overnight charges or the rollover charges. So every day we're in a trade, it's actually costing us more money as well. Not only that, is it is exposing us to more price shocks, it's exposing us to more risk. So as far as I'm concerned, if we can make the same money but in half the time, that's a lot better, isn't it? And the last column, we just want to look at the largest losing trade. Now this is quite important. Using no stop loss, just the stop and reverse, over this back test, the largest loser was 24,000. Using the 500 pip stop loss, we never saw a loss more than the 500 pips, which is equivalent to the 5,000 where you see highlighted. The 11-day hold, when showing a loss, did see a much larger one loss of 9,700. So that wasn't quite as good, but I'll talk briefly about that later on. And the 11-day hold with the 500 pip stop loss, again, so we've got like a guaranteed, or as guaranteed as it can get, of a 500 pip loss, so we can see we have got the 5,000. And the 16-day hold, regardless of profit or loss, was a very high, largest loser of 20,000. So that's the bulk of the results which I wanted to show you. I think it's quite useful the way I've put it into that table like that. Let me know what you think. And as far as I'm concerned, apart from that largest losing trade, we can clearly see that using that 11-day timed exit, if we're still in a loss, is definitely the most effective. The only other things that I want to show you is the equity curve and the optimization reports for each of the 5 variations of this strategy. And we'll go over to multi-charts, which is the software which I've been using, and have a look at that in just a second. But just before we do that, if you're looking for new rule-based trading strategies, a little bit like this one today, then you'll probably like my 22-page Beat the Market Strategy Guidebook. In there I've documented all the rules and the backtest reports for 3 more of these rule-based strategies. And at the moment you can get that absolutely free if you find the link in the description down below. And for those of you who want to take your trading to the next level, you should probably check out my trading course. And in the trading course, there's another 6 strategies, again, which I outline with all the rules, and I even give you the codes for multi-charts and TradeStation. The strategies aren't just what the course is about, there's other many critical lessons in there. But you can find out more information about that going to the page, if you find the link, again, down in the description down below. So let's go and have a look at the equity curves and the optimization reports for each of these 5 exit variations on this strategy. Here we are in multi-charts, so let's have a look. And I've put each of the 5 charts just in one workspace. Let me just expand one of them so that we can see. This is our basic, just our stop and reverse. It's our exit number 1, stop and reverse only. And we can see we've got trades here, look. We can see we've got 4 red bars and then we go long. Then we're going to wait for 4 green bars. We don't get 4 green bars until here. We exit our long position and we go short. And then we'd get out when we saw 4 red bars. We haven't seen 4 red bars yet, so we're still short in that position. What I'm going to do is I'm going to run through pretty quickly, just show you the equity curves of each of the strategies, and I'll show you the optimization reports for some of the optimizations on the stop losses and the timed exits. By the way, for those of you who are interested in how I use multi-charts, this software, I've just created a multi-charts user guide. It's a fairly basic guide showing the essential parts of it, how I use the platform. You can find that on my website. It's completely free. I've done a series of pages all just on my website. Anyone can see that. So if you're interested, go over to the website and have a look at that. So let's look at the performance report, or the equity curve. There's the equity curve for just the stop and reverse. That's exit number 1. Okay, so it's definitely moving in the right direction. I'll just remind you that's from January 2008 through to August 2024. There was no optimization on this strategy, so we'll move on. So the second one here, this is where we're looking at the fixed pip stop loss. And I did run an optimization to see whereabouts the best fixed pip stop loss would be so we can make the comparison. And I run an optimization from 0 through to 800 pips. You can see in this right column here we've got my pip stop, and I've got from 0, which is not a 0 pip stop loss. 0 means we're using no stop loss whatsoever. So essentially that's like the results we saw in the previous window. And you can see if you scroll down, we've got through to 0.08, which is equivalent to 800 pips. Let's have a look at the 2D graph, and we can see we've got 0 here, which almost makes most net profit. It doesn't. We do have some better values here in terms of net profit. We're going in steps of 25 pips, so 25 pips is pretty awful, 50 pips, 75, 100 pips, 200 pips, etc. And I saw a stable area, anything from about here, which is about 425, through to 750. So I did go somewhere in the middle, and that's why I chose the 500 pip stop loss. Let's look at the equity curve. That's what the equity curve looks like with the 500 pip stop loss. Not too dissimilar to using no stop loss at all. In the next one, this is exit number 3. This is where we used our timed exit if we're showing a loss. First, let's look at the optimization, and I've optimized my timed loss stop. That means my timed exit if we're showing a loss, stop loss. I've gone from 0, which again is using no stop loss whatsoever, and then I've gone from 1 bars through to 25 bars. Looking at the 2D graph, we can see exiting after 2 days, 3 days, 4 days is pretty bad. But as soon as we get, so this is using no stop loss whatsoever, but as soon as we get over about 9 days through to maybe 19 days, there is a reasonable stable area there. The best value being, I guess is it 11? Did I choose the best value? No, the best value was actually 10 days. Here, look, so I purposely didn't choose the best value, and I chose 11 instead. So that's our 124,000 net profit. So I could have actually chosen 10 days, but that's just optimizing for the results we've got. I didn't want to do that, but 124 is a reasonable stable area. Is it the third best in terms of net profit? Best is 140. We've got 125, then 124. So 11 was actually the third best result. And that's what the equity curve looks like. And again, probably a little bit smoother, especially in the early years, but really not too dissimilar to the others. The next test, we've got the 11-day exit like we've just seen, but we've also got the 500 pip stop loss. And I didn't run an optimization on this, I just combined the 2 exits. And that's what our equity curve looks like. Again, reasonably similar. And lastly, we've got our timed exit. Now, we're exiting after X amount of bars, regardless whether we're in profit or loss. So, of course, I run an optimization on my timed stop from 1 through to 25 bars. And we can see that using no stop loss whatsoever was definitely the best. So overall, this general timed stop didn't work particularly well for this strategy. But anything from about 9 bars the whole way through, really, 9 bars and upward actually made money. I think I chose 16 bars, which again wasn't the best value, but it was one of the better values. 16 making 83,000. No stop loss made the best at 112. Then we've got, what's the next best? 92 there. We got some 88s, 89s, 88. So what I chose wasn't the best, but it was within a stable area. And let's have a look at the equity curve. And there's what the equity curve looks like. Not quite as smooth as maybe some of the others. So it's quite hard to compare the equity curves looking at them one by one like we've done, but I think you find that the one with the timed stop loss was the nicest. Probably was one of the most smoothest, but there really isn't a lot of difference. It's only when we actually look at the performance numbers that we do notice the big differences. So there we have another type of exit strategy or stop loss, which increases the net profit, reduces the drawdown, and all the while is in the trade far less amount of time, making the strategy much more efficient. The only downside which I can see is that we don't know prior to the trade how big or how large our maximum loss on that trade is likely to be. So this has to be a big consideration when calculating your position size. At least with a fixed stop loss, like a fixed 500 pip stop loss, you know that the majority of the time you're never going to exceed that 500 pip loss on any one trade. But while we don't know any max loss per one trade, what we have seen in the extensive backtest that using the timed exit, the overall drawdown is much smaller than using the fixed pip stop loss. And that means we can calculate position sizing based on the maximum historical drawdown rather than the maximum one loss for any individual trade. But position sizing is a whole nother video. So anyway, thanks for staying till the end of the video. I hope you've enjoyed the video and I hope you've learned something today. And I hope it's got you thinking about different options for stop losses. And for you regular guys, sorry I haven't uploaded recently. It has been a very busy summer. I'll try and increase my upload schedule soon, so keep an eye out for new videos. Anyway, I hope to see you on the next one. But until then, this is Jared Goodwin, and thank you.